A signal just appeared in the silver market that historically shows up before the biggest moves. Not every year, not every cycle. Only when the physical market begins pulling away from the paper market. Right now, that divergence is growing. Inventories are falling. Industrial demand is exploding, and commercial traders are quietly changing their positioning. It's not our job. Most investors will not notice this signal until silver is already much higher. Today, we are going to break down exactly what it is and why it matters. The last time I saw a setup like this in the silver market, I made a call that cost me more sleep than I care to admit. That was 2010. I was right about the direction, but even then I did not fully grasp how fast the mechanics could unwind once the signal fired. What we are seeing now is not the random price spike most analysts keep describing. It is something far more structural. And the difference between a random spike and a structural signal is exactly where the real stakes sit for every investor watching this unfold. Most people are asking how high silver can go if it clears the next resistance level. They are asking the wrong question. The right question is why the metal has suddenly started behaving as if paper supply and physical reality have stopped speaking the same language. And what has to break for that conversation to resume? I will show you the one number that reveals exactly how close we are to that breaking point, but first you need the full context, because without it, everything that follows will feel like just another bullish story instead of the mechanical warning it actually is. It's not our job. There are three dynamics converging right now, and each one on its own would be significant. Together, they create a situation the standard models were never built to handle. Reports suggest eligible silver stocks in COMEX vaults have declined by on the order of 50 million ounces in recent months. That is not a small decline. That is a structural problem. Think about this. If a single large industrial buyer decided to secure just 6 months of future supply, at current rates, it could consume a meaningful percentage of the silver available for immediate delivery. That is how tight this market may already be becoming. Sit with that for a moment. To understand why this matters so much, we have to go back to a historical example almost nobody talks about anymore. It is a forgotten warning from the late 1970s and early 1980s. Back then, visible inventories had been grinding lower for years, while industrial offtake, particularly in photography, electronics, and emerging new technologies, was rising steadily. According to market data from that period, the paper market on the exchanges had grown comfortable with a certain range. Commercial participants maintained large short positions, assuming supply would always meet demand at predictable prices. What they did not fully appreciate was how the physical market was beginning to diverge. Then the mechanics shifted. Positioning became more concentrated. Demand from both industry and certain large buyers accelerated. What started as a modest premium in the physical market turned into a scramble for actual metal. The price did not rise gradually. It exploded. What many remember as a simple bull market was in reality a violent repricing driven by the collision of shrinking inventories, paper promises, and real world consumption that the models had underestimated. The move took silver from single digits to nearly $50 in a matter of months. Delivery notices surged. Refineries worked overtime. Physical buyers outside the futures market paid whatever was necessary to secure bars. When the episode finally resolved, it did not end with a gentle correction. It ended with a multi-year bear market that punished late arrivals and rewarded those who had understood the mechanics early. I need you to hold that history in your mind because the pattern is repeating with important differences. That was the reset. Now let us return to the present with clearer eyes. The second dynamic is industrial demand, which has accelerated far beyond what most surface level commentary captures. We are not talking about jewelry or silverware. We are talking about the energy transition, solar photovoltaic cells, electric vehicle components, 5G infrastructure, and the enormous data centers required for artificial intelligence. Major institutional research desks now model a market deficit on the order of 200 million ounces this year. That is according to Bullion Desk Commentary, one of the largest supply gaps in decades. unlike gold, silver is consumed in these applications. Once it goes into a solar panel or a high-efficiency contact, it does not come back. Imagine a factory manager in China who needs silver next month. He does not care about analyst opinions on television. He does not care about daily fluctuations in the dollar index. He cares about getting physical metal into his plant on time. And when enough of those managers start competing for the same shrinking pool of refined bars, the entire character of the market changes. That human reality is what the charts rarely show you. The third dynamic ties the first two together through the derivatives market. For years, the COMEX paper price has functioned as the tail wagging the physical dog. Systematic strategies, hedge funds, and commercial shorts built models, assuming silver would remain in a reliable trading band relative to gold. Those models are under stress now. Market data indicates commercial short positions have begun covering at levels not seen since the last major physical squeeze. Open interest remains elevated. This is the classic setup where paper promises start colliding with the reality that there may not be enough metal to settle every contract if a meaningful percentage of holders demand delivery. Here is the number I have been telling you about, the one that reveals exactly how close this imbalance is to breaking. 30 million ounces. If COMEX eligible inventories fall below that critical threshold, the buffer between paper claims and actual physical metal becomes dangerously thin. That is not a minor technical level. That is a structural alarm. Now, forget the headline price for a second, because the price is not the point. The point is what it reveals about who is on the other side of the trade. There is a growing divergence between the quoted futures price and the premiums being paid in the physical market. In Asia and parts of Europe, wholesale buyers are reportedly paying premiums of 10 to 20% over spot for immediate delivery of refined bars. That spread does not show up cleanly in the COMEX pits. On paper, everything can still look orderly. In the real world, metal is getting tighter by the week. This paper versus physical divergence has appeared before. Each time it is resolved, it has done so with force. I want to be honest with you about something. I am not sharing this because it is comfortable. I am sharing this because I have sat in rooms where these inventory drained AIN's delivery schedules and physical offtake numbers were discussed quietly. The people in those rooms have strong incentives to keep the system functioning smoothly. But incentives and reality do not always align. Global mine supply has been essentially flat to declining for years, while demand has gone vertical. New projects face delays, permitting issues, and rising costs, according to multiple institutional reports. The market is not replacing what it consumes. That gap does not close itself. The last time conditions like this aligned was 2010 into 2011. Most people remember silver running toward $50. What they forget is the path. It was not a straight line. It was a series of violent, short-covering episodes layered on genuine physical tightness. COMEX delivery notices shocked even seasoned traders. Industrial users in Asia sourced metal outside normal channels. Physical premiums in key markets spiked as buyers competed for bars. The entire episode took roughly 18 months to fully play out. When it was over, silver had not simply corrected. It had repriced an entire decade of suppressed supply signals. But here is the part most analysis leaves out. The 2011 precedent actually understates what we may face today. Back then, solar represented only a small fraction of industrial offtake. Today, it is one of the largest drivers. Artificial intelligence infrastructure was science fiction. Today, it is consuming silver in quantities that compound the pressure. The geopolitical layer is thicker as well. Production remains concentrated in jurisdictions where labor disputes, political shifts, and export considerations can create sudden disruptions. Should any of those risks scale up, the supply response time is measured in years, not months. The models simply do not capture that asymmetry. The thesis has not changed, only the price has changed. Keep that phrase in your head. It matters. Now, let me be honest with you, because I think credibility matters more than comfort. There is a serious counterargument here, and we need to take it seriously. The bear case is straightforward and well supported by many large institutions. Silver remains primarily a leveraged play on gold. If real yields rise materially, if the dollar strengthens significantly, or if a meaningful economic slowdown reduces industrial offtake, silver could give back gains quickly. We have seen exactly that pattern multiple times in the past decade. The mining industry can and does respond to higher prices over time. Recycling rates increase when incentives improve. Central banks have shown aggressive buying in gold, but no comparable urgency in silver. If gold enters a consolidation phase, silver could easily underperform on a relative basis for months. That scenario is not only plausible. For many desks, it remains the base case. I respect that view. I have watched it play out. Yet the thesis still holds in my judgment because the counterargument focuses heavily on financial and monetary demand, while the data increasingly shows the dominant marginal buyer today is industrial, not speculative. The paper versus physical divergence is not something that can be wished away by a stronger dollar alone. It is measurable in delivery schedules, refinery backlogs, and the behavior of actual consumers. The specific data point that would change my mind is a sustained rebuilding of COMEX eligible inventories combined with clearly falling industrial purchasing managers index readings across key regions. Absent that combination, the structural forces remain intact. The signal has appeared. The question is whether we treat it as noise or as information. The single most important number to track right now is that COMEX eligible inventory level we discussed. When it moves below the 30 million ounce threshold, it tells you the buffer is nearly exhausted. I need you to hold that number in your mind. The second metric is the weekly CFTC Commitment of Traders report. Watch for continued commercial short covering. When those net short positions drop, while managed money remains net long, the squeeze mechanics strengthen. Third, track physical premiums in the Shanghai and Indian wholesale markets. Those premiums act as a real-time pressure gauge. When they widen, even as the COMEX price pulls back, the divergence is sending a clear message. Finally, watch the gold-silver ratio. If it breaks below 75 to 1 and holds, that is technical confirmation that industrial demand rather than pure monetary flows is driving the repricing. 6 months from now, you will either be the investor who understood this signal and positioned with conviction, or the one who waited for permission from mainstream headlines. I have seen both outcomes play out dozens of times. The difference is never intelligence. It is the willingness to sit with discomfort before the crowd validates the thesis. The information is all public. The difference is never information. The difference is behavior. Most investors will hear these numbers and move on. It's not our job, but if you are still here, if you are the kind of person who needs to understand the mechanism before the move becomes obvious, then what I have laid out should reframe how you see the entire silver complex. Remember the historical example I shared earlier from the late 1970s. Here is why it matters now. The signal then looked strikingly similar, only the industrial tailwinds were far weaker than today. Today, those tailwinds have become gale forces. The divergence is no longer sustainable. The thesis has not changed. Only the price has changed. The escalation we are witnessing is not merely another commodity cycle. It is the intersection of the energy transition with decades of underinvestment in primary silver mining and a derivatives infrastructure built for a different world. The mechanics speak clearly enough without speculation. Vault flows, physical premiums, and positioning data tell the story. The signal is not in the silver price. It is in the movement of metal itself. And by the time the price fully reflects that reality, the signal will already be gone. Most people watch the price. The smart money watches the metal, because the signal is not in the silver price. It is in the movement of metal itself. And by the time the price fully reflects that reality, the signal will already be gone. If this is the kind of analysis that changes how you see the market, then WealthWired was built for exactly that. The people who come back to this channel week after week are not here for hype. They are here because they want to understand the mechanism before the crowd sees the headline. That is what we do here, and if that matters to you, you already know what to do. This is education and discussion, not personal financial advice. Do your own research. Manage your own risk.